let's go over the direct labor variance. So we go back to this same example. Now we're going to be focusing on the direct labor. Here's the standard. It's going to take 1/10 of an hour. We pay our workers $12 an hour, so it costs 10.10 times 12 costs $1.20 in direct labor to make 1 unit. And again, we produced 10,000 units, and here's our actual direct labor hours, our actual direct labor costs. So we want to find our budgeted labor. So it should cost us $1.20 to make 1 unit, and we made 10,000 units. So our budgeted labor cost is $12,000. Our actual direct labor cost, we're told right here, is $11,250. So if we go to our flexible budget, we've got $12,000 for direct labor, actual is $11,250. We can see our variance is $750, and since the actual direct labor is lower than the flexible budget, that's a favorable variance. And so we want to investigate that. Why did we have that favorable variance? Well, we can break this down. Part of the variance is due to us paying a different rate than the standard. Part of it is our workers used a different number of hours than the standard. So to calculate the rate variance, how much of it the direct labor variance is due to us paying a different rate to our direct labor workers? And we calculate that by taking the actual hours and multiplying that by the difference between the actual rate and the standard rate. So in our example here, we're told the actual hours is 900. Our actual rate is not given to us, but we can figure it out. Because we know we paid $11,250 for our workers to work 900 hours, right? So 900 times whatever that rate is, it's going to give us $11,250. So that means we can back into that number. We take the $11,250 divided by 900. That means the actual rate worked out to be $12.50. So we'll take $12.50 and we'll subtract our standard rate, which was $12 an hour. So this works out to be 50 cents times 900. We get a variance of $4.50. And since our actual rate was higher than the standard rate, that variance is unfavorable. Now let's look at the efficiency variance. How much of our direct labor variance is because we used a different amount of hours than the standard? So we're going to take the standard rate and multiply it by the actual hours minus the standard hours allowed. And the standard hours allowed is how many hours would we have used if we met the standard for every unit. So we take the actual units produced and multiply it by the standard amount of time it should take to make 1 unit. So here in our example, we need to compute the standard hours allowed. So if we met our standard for every unit of these 10,000 units we made, how many hours should we have used? Okay. Well, we're told we should use 1/10 of an hour per unit. So we take that 10,000 units produced, multiply it by 1/10 of an hour. It should have taken us 1,000 hours to make those 10,000 units. So to get our direct labor efficiency variance, we start with our standard rate, which is $12 an hour. And we're going to multiply that by the actual hours, which we're told the actual hours were 900, minus the standard hours allowed of 1,000. So 900, the difference between 900 and 1,000 is 100 times 12. It gives us a variance of 1,200. Since the actual hours were less than the standard hours allowed, that 1,200 variance is favorable. So if we look, that 750 favorable variance can be broken down to Our rate variance is 450 unfavorable. Our efficiency variance is 1200 favorable. So we paid higher, right? This is how much is due. We paid a higher rate, but we used less hours. We got it done faster. And we can talk to the HR supervisor, the plant supervisor. Why did we pay a different rate? Maybe the market was higher and just the labor market changed and we had to hire workers at a higher amount. But it could be a situation where we had a different skill level of workers working. So we talk to the plant supervisor and see who was paid to be on that job. So in our situation here, we could have had higher skilled workers working and they were able to work faster. Okay. And so that's why we had the favorable efficiency variance. So that's what the production supervisor. What caused the workers to take longer than expected? We could have a situation where we had lower skilled workers. The rate variance would have been favorable in that case, but then they would have worked longer. And so then we would have had an unfavorable efficiency variance. And then sometimes this also comes into play. There could kind of also affect the direct materials variance. If we talk to the production supervisor, we had lower skilled workers, maybe they had more waste. They could have used a more quantity of direct materials. So that could be a situation. So sometimes these variances are interrelated. So that's why we need to talk to the various people in the organization and investigate why. So now let's take a look at the variable overhead variance. And so we know our predetermined overhead rate is the estimated overhead divided by the estimated allocation base. And the estimated allocation base is commonly direct labor hours or machine hours. Then we use that rate and multiply it by the actual machine hours or direct labor hours. So when we see a variance, it's going to be different there could be a few reasons why it's different. The actual overhead could be different than the estimated overhead. The actual allocation base can be different from the estimated allocation base. So that's going to give us an incorrect rate. And then the allocation base is also used in the allocation. So it could cause a variance there. So we're going to look at two parts. The rate variance, the difference due to the actual overhead rate being different than the standard rate. And then the efficiency variance, which is the actual allocation base is different than the standard allocation base. So here's our example. We produce 3,000 units. Our standard rate is $8 per machine hour. Our actual rate ended up being $9.50 per machine hour. Okay. We should have used 0.25 machine hours per unit. Our actual machine hours used was 770. So to get the rate variance, how much of our variance is due to us having a different rate than the standard? We take the actual hours times the actual rate minus the standard rate. So let's think about this. How many machine hours should it take to make 3,000 units if the standard is made? Well, each unit should take 0.25. So if we made 3,000 units, 3,000 times 0.25 tells us that our standard hours allowed would be 750. So our flexible budget manufacturing overhead would be the $8 standard rate times the 750 hours. So 6,000 should be our flexible budget variable manufacturing overhead. The actual overhead, so $950 per machine hour times 770 machine hours, so 7,315. And you could have also been given this differently. You could have been told the 7,315 was the actual overhead. That would probably be the more commonly way you would see it. If we were told there were $7,315 of variable overhead and there were 770 machine hours, you would divide to get to that 950. So here we can see our flexible budget variance, the difference between the actual variable overhead and the flexible budget variable overhead, is 1,315. And since the actual overhead is higher, that's an unfavorable variance. So, to find out how much of that variance is due to us having a different overhead rate than the standard, okay, and we can see the overhead rate variance might also be called the overhead spending variance. So we calculate that by taking the actual hours times the difference between the actual rate and the standard rate. So our actual hours are 770. The actual rate worked out to be 950. The standard rate was 8. So that comes to $1.50 times 770. 1,155 is the rate variance. That's going to be unfavorable because the actual rate ended up being higher. So that's the portion of our variable overhead variance that's due to our overhead rate being different than the standard. Now the other piece is looking at the difference in our allocation base. How much of that variable overhead variance is due to us using a different number of machine hours than the standard. So it's the standard rate times the actual hours minus the standard hours allowed. So our standard rate we know is the $8. Our actual hours were 770. And then our standard hours allowed we said was 3,000 units. Each one should have taken 0.25 hours. So that was 750. So 20 times 8 gives us 160 as a variance. Since the actual hours were more than the standard hours allowed, that's an unfavorable variance. And so we can see this 1315 unfavorable flexible budget variance. 1155 is due to us incurring a different overhead rate than the standard. And then 160 is because the machine hours were more than the standard.